Hi, good afternoon, everyone. My name is Michelle D. I'm a regional head in UK Export Finance Business Development Team. UK Export Finance is the UK Export Credit Agency, so our focus is on supporting UK exports by providing financial support to the overseas buyers of these UK products, goods or services. We have done a lot of business across Africa, about 2.3 billion last year. And our fine suite of products includes buy credit guarantees, which we can issue in local currencies, in a range of local currencies. So I think there's about 7 in Africa. And others that we can contemplate on a case-by-case basis. It's not a product that we've used much so far, and maybe we'll come back to that later. But yeah, keen to hear more thoughts about how we could develop that product more or expand the use of that product more.
Ainel.
Good afternoon. My name is Ainel Henry. I am the head of structuring at Rand Merchant Bank. Previously the head of ECA and insurance. Thank you.
Hello, everyone. So, Alaric Danyem, I'm the head of project and export finance at Deutsche Bank, based in Dubai, covering the whole continent. So, very happy to be there for a very sometimes controversial debate that Gabi likes. But yes, local currency funding is available. Deutsche Bank has this capacity in South Africa. We should do more on that space.
Hello, thank you. Hello, everyone. My name is Joe Samen. I'm the managing director of Garanco for Africa. I'm based in Nairobi. I'm going to talk about Garanco a little bit more when I do the presentation on 2 transactions that we want to present here as case study.
So just to be open with you, Arnel and I used to work together many moons ago. And I was at Barclays, Arnel was at ABSA. And we had a very unique mix in that we had, from a London perspective, the global ECA financing team. And, but also through ABSA, we had the RAND financing. And slides, please. And we saw a benefit of being able to do local currency RAND financing to SOEs here in South Africa, where which made the debt compliant to the PFMA, the Public Finance Management Act. And this slide here, yeah, this is one. The ECAs were able to provide us with lower premiums. In those days, a 35% reduction in the OECD premiums. There was a huge interest in terms of the fixed income market in buying these assets because we did this with UKEF and with other export credit agencies. They particularly liked the 100% political commercial guarantee. We as a bank at that point in time were willing for these assets to be funded through the fixed income market. ECAs, I think, and the ECA banks were seeing this as a benefit in terms of fulfilling the needs of the buyers and the buyer's perception of risk. And it was in my opinion, the ECAs saw it as being a key tool in terms of sustainability, which is why they offered the reduction in the premium. We did billions of this stuff in dollar terms across a number of different ECAs. But the question I'm going to really put to Ainel first, and why hasn't it been repeated?
Thank you, Gabi. And just for the avoidance of doubt, Gabi was my boss, so we didn't literally work together. He gave instructions, and the rest of us followed. Gabi, it's a very interesting point, and we'll start off by saying first, obviously, that the South African market is different, slightly different when it comes to the depth of market, the buoyancy of market, and the currency issues, as between South Africa and maybe the rest of sub-Saharan Africa, where you have more dollarized or euro-type hard currency transactions. In South Africa, we've been very fortunate and very good at enforcing, local currency transactions, particularly in the infrastructure space, and mostly because of the PMFA. and the requirement of SOEs, governments, and a lot of corporates to hedge that risk back into South African rands. So that's been the cornerstone of some of our financings. On the rest of the continent, we must also acknowledge that there have been impediments to why we haven't used local currency financing more. Firstly, around perhaps the pricing, local currency pricing, the base rate of local currency pricing versus the recent rates or recent downturn rates of both the US dollar and euro have proven to be slightly more expensive. Okay? There has been questions around the depth of market as well as the volume of liquidity at certain points. And I do have a slide on that we can look at just now. But there has been questions around how much local currency is available in the local market for both the primary bank market, the secondary market, and then perhaps for the capital markets to support when it comes to these infrastructure financings, okay? And how we can crowd in those respective players in the local market in order to do that, okay? Gabby, sorry, just quickly. Also, sometimes when we structure as financiers, whether it be project sponsors, whether it be bankers, whether it be developers, our motivation in structuring is to wrap the project neatly and nicely, where we're mitigating it on various levels, and providing a full-on package that is executable now, as opposed to structuring for sustainability.
Okay, can I just stop you there? So, Michelle, do you give 60, 62 currencies that you can do an export credit? You're head of Africa. Mm-hmm. How often is it a point of discussion for you with both exporters, buyers, borrowers, investors?
Yeah, it's a good question. So it's not very often a point of discussion. So as I was saying, we haven't done many local currency transactions. It's a product we launched a while back. And the demand for it has been very, very, very low. We're very happy to have these discussions. Very often, from our point of view, I suppose, the exporters do not want to be exposed to the local currency risk. And therefore, it's a matter of finding exporters who have local operations that they will need, where they will need to have this local currency to pay for these operations locally. And to date, as I said, yeah, it's not a debate we've had very often with exporters.
Okay, Alaric, from a Deutsche, you're looking at this, and what's your viewpoint in terms of the demand from both a bank perspective? Do you see this something that you want to do?
We should do more often. I hope you can hear me correctly. We should do more often. Again, it's a new product available for Deutsche Bank only 6 months ago. We have this rand deposit. We should do more in countries such as Namibia, Botswana, also the Kenyan shilling, where the liquidity is there. But I also recognize what Inal mentions. When the borrower compare the liquidity available in US dollar and euro, where you can tap ECA market at all-in pricing of 2%, and you compare with the local currency, which is reference rates around 15%. That's very the difference is very high, and partly considering in the future, what happened with the inflation rates. So that's an important element. However, for some probably project finance where the end customers are paying in local currency, I think it's definitely doable. And let me, Gabby, maybe go in details already now, if you're okay, regarding what the country has done on the renewable program. That was fantastic in terms of the FIT tariff, in terms of the liquidity of South African bank. And what is interesting is the comparison between local funding from South African bank and ECA funding. Of course, solar PV it's really coming from China, so this is not possible. But the wind could come from EKF, the Danish ECA, which can cover Vestas or Siemens Gamesa. When you go in terms of the all-in pricing, the fifth bids, and with the good interest of the sponsors and also the local banks, ended with a all-in pricing of GBAR plus 275 basis points, around that. Very competitive. If you compare with ECA, and even if, as you said, Gabi, you have these 25% reductions of the premium, you ended with 325 basis points. So there's a 50 basis points gap that we need to bridge.
Yeah, but whoa, okay. Name me a country in sub-Saharan Africa that's defaulted on its local currency sovereign bonds. None. Name me a country that's defaulted on its hard currency debt because its local currency is devalued against the hard currency debt it's got. You've got a long shopping list. Okay, so I think, and I know this is a point, Jules, you want to pick up, and so therefore I want to pass the ball, if I may, to Jules and just say, this question about interest rate risk versus FX risk, what do you think needs to be solved to change that mentality?
I think it's a little bit difficult to give an answer now, because it depends on how lenders view where the issue is, right? So at Garanco, we believe that local currency is the best solution to finance infrastructure, because I really don't understand why you have receivables in local currency and then you provide hard currency. You're creating long-term issue for the end users, right? You probably need to find a solution on how we as lenders can get in there and finance local currency. And I understand her point when she was talking about the cost of the local currency, which is really high compared to hard currency. But the reality is that we always look at the first value of the cost. We don't see what will happen if there's any currency depreciation. Because if there's any currency depreciation, who will bear the cost? The end users. And if we want to do development, the first people we need to think about are the end users. So I think we as DFI, we need to sit down and find a way to do local currency. It's clear that the local currency market in terms of liquidity is not that huge compared to hard currency. But if we want to build a market, we also need to start talking to pension funds, insurance companies, to see how they can put their money into such project instead of term deposit, which is not really helping the country in terms of development. So I think everybody should be thinking about how can we increase the local currency availability in the market. And the question about the pricing is there. I think we might find some solution for that. And also the question about the currency exchange, we need to find a solution for that. Do we still need to throw in hard currency there? I know that in few years' time, something can happen and people will suffer for it. Or do we think that we can sit down now and try and find a solution and close the issue now and build up more infrastructure for local people?
Sorry, Gabriel, I was going to say as well, my earlier statements about structuring for sustainability. Sometimes we structure for expediency, and as I was saying, we close deals now and don't look at the long-term effects. Without indicting myself too much, I will say that sometimes we need to consider the currency convertibility effects that transactions, particularly large-scale hard currency transactions, have on both the sovereign balance sheet in terms of the debt to GDP ratio and then currency inconvertibility down the line. And that we can't always risk mitigate upon layers, either through the DFI or multilateral market where we are offered PCS status or the ECAs at that, and or through the private markets as well. We need to look at how we can actively and dynamically innovate so that we're not calling on those mechanisms, but structuring for sustainability. Okay.
So, I mean, Eric, I get it. You know, I mean, I was a banker, and when we provided a hard currency debt, there would be an interest rate differential between what let's say, the euro or the sterling or the dollar yield was on that loan versus a local currency. But we would, you know, as an industry, we would never really flag. We would never flag to the borrower the what if scenario, that if their currency devalued by 30%, what that would mean to them. And I'm looking to you, Michelle. Do you ever look at, because I know that, you know, UKEF, you do have this kind of value for money sustainability criteria. And although banks don't come to you saying, let's look at trying to do something in Ghanaian CD or in, you know, Tanzanian shillings, but do you look at this? Do you try and encourage the market to be much more progressive?
Yeah, it's a good question. So we do offer local currency financing where we can to borrowers.
But that's if I may interrupt, but that's you react is what I'm.
Yeah, yeah. No, well, yeah. When we present our suite of product, we would, you know, I think we would encourage them to go down the route of local currency financing on the basis of the sustainability points, and you know, our premium will reflect also, you know, the price of the premium will reflect the local currency financing. But it's about finding the liquidity for it sometimes. And also, to add what's always been said here, I think the term, some markets do not have the depth in terms of the tenor, I don't think, in local currency
I'm going to flip a couple of slides here, if I may. I'll come back to this one in a minute. And hopefully I'll get the slide that Einel has come up with. Please. So this slide here, this I found, I asked Arnold to look at this on this point. And this is the slide about looking at local currency bonds. And this is just a selected number of countries across sub-Saharan Africa that have issued local currency bonds. And what Arnold and her team have done is looked at the maximum maturity and the total amount in local currency and in dollar equivalent. And this slide is really important because I think this breaks the myth, which I've heard many times, not from you, Michelle, but from others, that there isn't the liquidity, there isn't the depth of appetite for doing this in local currency. And I think there is, you know, and I remember before we ever did the first one in Rand, everybody used to say to us, there's no Rand liquidity here on a long-term basis. And so when this slide does come up, Q, it'd be interesting to get your comments. And it's also from Jules. I'd be interested to get your viewpoint about educating the regulators both here in Africa and elsewhere, and whether that should be, you know, there should be greater incentive for local investors to be looking at this type of paper.
Again, Jules, before, I think we should just draw the distinction between the primary market, being the bank market and direct investment market, and then the capital markets as well.
Yeah, sure.
Thanks. So we just we looked at capital markets and the local currency bond issuances in a few jurisdictions in Africa. I must say that this was to look at particular data points in terms of the volume of liquidity and what is being raised and currently in issuance by these sovereigns. And it was very interesting data in that African sovereigns are raising in the capital markets, they are raising in local currency, okay? The deployment of these use of proceeds, though, is obviously not known because it is public raisings, right? But we're drawing analogies in terms of, do these jurisdictions have a somewhat regulated capital markets regime, and can they raise liquidity at those tenors? Pricing and coupons were not looked at, okay? So that for the avoidance of doubt, we did not draw comparisons in terms of that. Government of Botswana is a regular issuer in the 15 to 25 year space. Aggregate of issuance currently in circulation up to 25 years is $981 million, okay? So interesting, particularly because government of Botswana is a conservative borrower and does not have a euro or a dollar bond program as well. So only form of issuance. Nigerian government, so they have a euro bond program as well, but also active issuer in the 10 to 30 year space in local currency, and issuances in circulation at the moment up to 30 years is currently $23 billion. These are all local currency issuances, and we use
$23 billion
with the local currency.
in Naira funding for the government of Nigeria.
Today, this is the
Today.
existing,
Today, up to 30 years, okay?
not cumulative.
So, I'll cut to the chase. 23 billion, 30 years. Ghana, 1.3 billion, 20 years. Kenya, $14 billion, 30 years. Kenya infrastructure bond, 6 billion, 25 years. And Tanzania, this one I was quite staggered. Tanzania, 3.7 billion, 25 years. Okay, so there are fixed income investors willing to take these local currencies for that sort of amount, okay? The ECAs are never going to touch the size. We'd be lucky about 5 or 10% of that going into, but it's needed. So if I may cut to you, Jules, is there a role to educate the DMO, the debt management offices in these sovereigns about what they could be doing through ECA?
Yeah, I think capacity building, when you look at the African market, capacity building is something that we should really try and do as much as possible, because some of the things that happened in the market is just because people don't understand. I'm not going to say people don't know, but people don't see the value of that at the moment. So it's our role as DFI to make sure that we educate the market. It's not just educating the local banks, the pension fund, and insurance company. We also need to talk to the government and to show that there's a way for them to raise some capital in local currency. And again, doing that, they are also educating the whole capital market for people to know how the capital market works and what they can benefit from the capital market, right? So for me and for Garanco, it's something important. We have been trying to do capacity building workshop in many countries. We've done that in Cameroon, we've done that in Cote d'Ivoire. We recently did one capacity building workshop in Malawi and another one in Tanzania. And a lot of people turn out just to understand how things work and how they can use that to help the market. And the feedback from those capacity building workshops has been great so far. And we are getting a lot of calls from people saying, we were there listening to you about how we can raise funding in local currency. We have this transaction, can you help us? And we also get some call from the government saying, can you help us? We don't do government, but we use that opportunity to direct those people to our colleagues who can help support the government to raise local currency funding.
Okay, so I know, Alaric, you're pushing this, you're looking at this. What things do you think would make it easier for you to do local currency financing for social infrastructure in Africa?
Having this in-depth liquidity available. So, for example, in Kenya shilling, there is liquidity. So it's all about creating this liquidity and having that on stage, when an international bank can do that, because a lot of international depend on local presence. So that's one. Second, you mentioned earlier maybe an increase of the discount of premium. So it's 20-25%, but at the end, it could be a little bit better. Third, it reminds me what the other panel, Gabi, in terms of the sustainable debt and in terms of the grant and the concessional element, the question that I ask. If you think about that, if you have a project where probably 50% of the debt can be local currency, and because there is no liquidity or there is some specific features which cap the local currency at 50%, plus another 50% hard currency. At the end, all my concessional element is good, because at the end you achieve 50% in local currency. So that's another element.
I'm gonna
fourth
interrupt-
one.
Okay,
Let me go
okay.
with the fourth one, which is what's happening on the, and this is finishing my initial remark regarding renewable program. In South Africa, a lot of South Africa banks are very exposed on the renewable. So probably post-COD, they will sell the assets to pension funds. We know that pension funds have this liquidity, but they are very well exposed. So I believe that the ECA can really be there and also structure a financing which can be even more competitive than the South African clean tranche. And let me explain that. For example, again, coming back to EKF, you can have the fixed rate available under the ECA, the C rate. And what is possible is that under this typical transaction where the sponsor wants to sell their assets after 5 or 8 years, you can create a soft mini-perm of 5 to 8 years. You fix that until 8 years, and after it's floating. So if you compare all in cost, even if the ECA might be a little bit higher, diversifications, fixed rates, they are all advantage to do ECA local funding.
Okay, I'll come back to you on 2 of those points. One, and I'm happy to be corrected on this, but and over many years of looking at this, when you have concessional finance and you need for concessionality, it only applies to the hard currency debt, so not for local currency. So the IMF, World Bank, you are exempt. If you have a local currency financing, you're exempt from having the need for a grant or concession. And believe me, I've been looking at this for years, all right? So I'm happy to be corrected on this. So with that, I'm going to turn to you, Aynal.
But sorry to interrupt, but again, let's change the lines, let's change the borders. I agree with you, but if at the end 50% of the project is funded locally, that could be an equivalent of 20% concessional.
Sorry, I'm going the other way.
You know,
I'm saying, why don't you do the whole lot, 100% in local currency? So Aynal, answer on that point.
Gabby, in the South African context, there's no reason why we should not be doing 100% in local currency financing. I just wanted to go back to some of the points that Alaric raised on the pricing of the ECA premium. So bearing in mind that we get LGD and PD substitution costs per our regulatory regime, so South Bank Regulation 23, that should in all instances be equal to or similar to the amount of ECA premium, okay? Subject to us not being, or subject to the South African government not being downgraded again on the OECD political risk scale. So that is something that needs to be taken up with the OECD as well, because that is directly affecting the premium and affecting the competitiveness of the ECAs to compete in the ZAR currency market in South Africa. Okay, it's very important. I think we're number 6 now. What are we? South Africa. We've been downgraded to 6.
No, I think you're 5, no? You shouldn't
5.
be 6.
I thought we were sub-investment grade.
To be confirmed.
I thought we were 5, yes. So that is directly affecting the competitiveness or the premium that Alaric is referring to, and why the ECAs in the all-in cost are slightly more expensive than the pure uncovered South African bank pricing, and that's in the primary market. So we need to look at that. But the second point, very importantly, is the diversification. What we are seeing in the market from a primary bank perspective and then a non-bank financial institution market perspective as well, is that we are aggregating, at the end of the day, huge credit exposure to South African government, because this whole program rolls up into the Department of Energy, which is guaranteed directly by the Fiscus of National Treasury. So we need diversification from, the A-rated ECAs in the world to come into this market and provide look-through or pierce the South African sovereign ceiling. So that is very important. Sorry, Gabby, slightly away from your local currency point. But it's so important for the buoyancy of the market going forward.
Yeah, but Alaric's point is very true. There is a huge over-concentration risk of the South African banks on the refit renewable energy program here, okay, which goes through government. And actually, if you look at South African banks, they are overexposed in terms of SA government, whether it's all the SOEs as well as National Treasury, etc., etc. And Alex dead right, but I still see behaviour of the South African banks just lapping this stuff up. And even if they do perceive that there's a risk transfer and give the diversification that Alaric was mentioning is needed, there isn't the culture here to look at that diversification. They just want to book hold long-dated assets.
Gabby, the mindset is definitely changing. And as you know, when we initially did these deals, it was all with a distribution mindset. Because of the new Basel impediments and the new Basel framing, banks can't hold these assets on their books long term. So the mini-perm type structures that Alaric was referring to are being put in place. And we can't match fund in any case. So hence why these are not assets that are suited for on-balance sheet, okay, from bank balance sheet, and they have to be moved into secondary and or capital markets. And I think a nuance or a trick of the rest of the continent is to look at how they can directly develop those capital markets and the secondary markets, where their banking market, where their initial primary market and or derivative market may not be as sophisticated or deep, and go straight to capital markets.
Okay. We're running over time, but we've got 5 minutes if you're willing to stay before the next session starts in the main auditorium. I like to put a proposition. I think the real challenge we have in this, in terms of developing what I think we all agree is needed, is that the real expertise about all of the big global ECAs is with the international banks. And the local currency funding, where they are naturally long in terms of, when you've got a big deposit base in sub-Saharan Africa, is with either local or regional banks who may not have the full expertise of the likes of Deutsche City and everybody else who do export credit financing. And really, for this to be solved, you need an arrangement, which is what we had at Barclays and ABSA. We had that kind of combination of the ECA as well as the local currency financing, and that's why it worked for us. But I can see why it doesn't work for big international banks. And so my question to you all is, do you think that is the main problem? And if it is, how do we solve it?
Maybe I can take that first. I think I am in this market from the last 8 years, and the numbers of time I am in South Africa, the connections between international bank and South African banks are super good. I mean, it's a pleasure to be there. We have regular calls with Ubank, with Nedbank, with ABSA to see how we can partner for this type of project. So I think it's just that some sponsors, coming back to the renewable program, have their own requirements. Feed tariff has been very, very low, and this is why when you have this liquidity because of this South African bank, you can take this. However, I think on the future of Africa, which is project finance in terms of sectors such as transportations, highway, this type of sector. We'll not do project finance for social development project, we know that. But for transportations, outside of the energy, maybe healthcare, or maybe educations, this is possible. And this is where, again, the cash flow will come from the local currency. So there is a capacity to work, I'm thinking about something concretely in Kenya at the moment, where under a toll road, you have the undertaking from a specific entity which is covered by the National Treasury in terms of a debt service undertaking, and this is the local currency. So you have a local currency tranche, and you have also a hard currency tranche. So that's, to respond to your questions, Gabi, that's probably the good partnership for this type of project.
Jules?
I think it's also depend on markets, right? Some of the market like South Africa is a little bit more mature than any other market. So you might see that collaboration in South Africa really tight, where in other market it's not the same. It's more of competition than collaboration, and that makes things a little bit complicated for the local banks.
Gabby, I would just say quickly, absolutely, there's a differentiation of markets and there's a differentiation of maturity across the continent. But we need sophisticated, mature borrowers to push back. Okay? We can't be relying on the sovereign balance sheet. The debt to GDP ratios are just hitting enormous levels at the moment. There is no longer any capacity left. We need to stop relying. So Jules and I have had long side conversations on this, on PCS.
Yeah.
Okay.
What is PCS?
Preferred creditor status. So when a project runs into, so I've seen it invoked on a very soft basis recently, where there was an issue in one of the countries to get hard currency out, and we need to stop using that as a catch-all, and structure for what we call sustainability, so that there's a good mix. Gabby, perhaps not 100% at this point in time, but definitely that they're bigger tranches of local currency to sustain these projects going forward. Yeah. And then from my side as well, Gabby, I would like to see evolution of the ECA documentation. I know some of the ECAs, like Hula Hermes, do have the securitization guarantees, but evolution of the documents so that they're covering a wider market, including direct capital market issuances, local currency.
And are you inferring to dropping the crystallization clause? I'm just asking. Okay. So, last word with you, Michelle.
Yeah, from our point of view, very interesting debate. We're very keen to work with, obviously, international banks who we work with, but also local banks. So some sort of collaboration between the two to get to this local currency financing would be fantastic, and we're really up for that. I really hear what you said as well about the borrowers, and that's probably on us to educate the borrowers, make them aware of this opportunity to finance in local currency.
Well, last word for Jim.
I just want to mention something important. Garanco, our aim is to support local currency, to provide guarantee for local currency infrastructure financing. And when we get into the market, we try to understand why the local banks are not financing infrastructure. There are many issues, liquidity mismatch, regulatory issues. And recently, last year in Togo, 2 years ago in Togo, we managed to get 14 years local currency financing for an energy project in Togo, in a market where you can only have 7 years maximum, because we provided what we call a liquidity extension guarantee. And we are also working on the same type of transaction in Madagascar, where we extend the tenure in Madagascar to 12 years. For a country like Madagascar, local currency 12 years is really tough. But yeah. I think what I'm trying to say is that there are some solutions, right? We just need to try and apply those solutions as much as possible, and also talk to the regulators, because the regulators are not just there to prevent local banks from investing in infrastructure projects. They are also there not just to regulate the market, but to help the market and to help the country to develop. And they are the ones who have to be well educated to understand that there are some products that we can put in place to push the tenure of the local facility a little bit more than what we can have in the market today.
And I'd like to finish on that point, because there was another bank I used to compete against, and he did that once in a project in Namibia where he got he did it in Rand, Namibian Rand, but he got the local regulators to agree that any bank or fixed income investor that bought that ECA wrapped local currency bond could treat it as a zero,
risk-weighted.
As a zero risk-rated asset. As a result of that, people from all over came out of the woodwork and said, I want to buy this paper.
Same thing happened in Cameroon. Nachtigal, the local banks provided 21 years financing for a 7 years market maximum, right? And the second transaction was done, which was KPDC's and IPP. Banks provided 14 years for a market at the time where the market can only provide five years. And the regulator gave their approval. Just because of that approval, more transactions coming in the market for a long term. That is the way to educate the market. That's the way to change things.
I agree. Listen, we've run over massively, but I'd like to thank you all for your insight. I know this has been a difficult subject and it is complex, but I firmly believe that we need to find a solution, because otherwise we're going to be looked at in 10 years' time as the group of people that have created another debt crisis in Africa. We need to find a solution. But thank you very much for your time and for your insight. Thank you.
Thank you.